For many Canadians, the RRSP is the first thing that they think of when they think about saving for retirement. However, there's many misconceptions about how RRSPs work. And so in this video, what I want to do is to help you understand how RRSPs work, debunk certain myths about RRSPs, understand all the details that you need to understand as an investor, and see whether it makes sense for you or not. Hi, my name is Nico Felipe from Vantage Planning, and in this video, I'm going to be talking about RRSPs. RRSP stands for Registered Retirement Savings Plan, and it was a program introduced by the government of Canada in the 1950s to help encourage Canadians to save for retirement. Similar to the TFSA, how the RRSP works is it provides Canadians certain tax advantages when they're investing into it. And there's three types. There's the individual RRSP, there's the group RRSP, as well as the spousal RRSP. Just like I mentioned in my last video on TFSAs, you really need to understand the difference between an investment and an investment account. Right? If you missed that last video, don't forget to check it out. I'll have a link to it up here, and you can see in the description below. But just to summarize it, an investment is something you put your money into to help your money grow, while an investment account is where you put your investment to help it grow faster. Right? And so this is a very important distinction with RRSPs, because the very first misconception is that the RRSP itself is an investment, when in reality it's an investment account. Right? And to make this simple distinction helps you really clarify how the RRSP plays a role in your investment plan and in your financial plan. So what's the tax benefit? So there's two main benefits that you get from investing into an RRSP. And the first one is that the money in your RRSP grows tax deferred. Meaning if you put your money into your RRSP, you invest it, and whatever that investment inside in it grows, whether it's interest, dividends, capital gains, it can continue to grow in the account without you having to pay taxes until you take the money out of the account. And to take the example of for retirement, say for example, you put your money in your 20s or 30s, you let it grow in the account until retirement, whether that's in your 60s, 70s, and you don't have to pay any taxes on it until the time you actually withdraw the money in your 60s and 70s. But what's important to understand is that you don't just get taxed on the growth, like in a non-registered account, you get taxed on the full amount that you withdraw. And this is a very important thing to note, and I'll go into this in further detail later on. But first, the second benefit that you get from contributing to your RRSP, the one that most people love, is the fact that you can deduct the amount that you contribute from your income this year or in any year in the future. So if you have $100,000 of employment income, you contribute $10,000 into your RRSP, all things being equal, you would have reduced your overall net income from $100,000 to $90,000, and in effect, you save money on taxes. And for many people, that comes in the form of a tax refund, depending on how much taxes you pay from your paycheck every couple of weeks or every month. People love this because they love the idea of letting their money grow in the RRSP tax deferred, while having the immediate benefit of having the tax refund or the tax savings today for whatever reason they want to use that money for. So what's the catch? Similar to the TFSA, there are two main things that you want to be aware of before you contribute into the RRSP. There's the contribution limits as well as the penalties. As well as there's a third one that I briefly mentioned, which is that you have to pay taxes when you withdraw the money out of your RRSP. And so I'm going to be going over each one of those more in detail. You can contribute up to 18% of your last year's earned income up to a certain amount. And in 2019, that was $26,500. Meaning that you get 18% of, for example, if you earn $100,000, you would have $18,000 of contribution room for next year, right? Or in the example of the maximum, if you make $150,000, you'll get the full amount of $26,500 for you to contribute into your RRSP next year. One thing to note is that if you don't take advantage of the contribution this year, it actually rolls over to following years, so you don't have to worry about losing the contribution room. A few things to keep in mind is that one, the CRA has a very specific definition for what earned income is, and so certain things aren't included in that calculation, such as your investment income. The second thing is there's not actually an age limit in terms of how early you can contribute into an RSP. You can actually start building contribution room when you're 14, when you're 16, as long as you're filing your taxes and paying taxes on the amount that you declare. There'll be certain times when your contribution limit will be reduced, most commonly when you have pension plans to your work. So if you have a defined benefit plan, a defined contribution plan, these might reduce your contribution limit for next year. So what you want to do is not assume that's going to be 18% of your income, but to actually calculate how much RSP room will be. However, an easy way to work around this is just to check your notice of assessment that comes every beginning of the year, or you can actually check on My CRA online. All you need to do is to log in through one of your online banking logins with one of the major banks, TD, RBC, Tangerine, any of those, and you can see that information online. Similar to a TFSA, there are penalties incurred if you overcontribute past the contribution limit amount. It'll be 1% per month for the excess amount. The only difference is that for RSPs, there's a lifetime amount of $2,000 that you can overcontribute without incurring any penalties. This means that if you overcontribute by $2,000, there are no penalties, you don't have to pay the 1%. The only difference is that you don't get the tax deduction on that $2,000. And once you get past that $2,000 once, then that's when you incur the 1% penalty per month. You will continue to get charged 1% until you withdraw the money out of your RSP, or if you wait until next year when you get new contribution room. So the third thing you want to consider, the one that I really want to emphasize, is you don't want to forget that you actually have to pay taxes when you withdraw the money out of that account. And this is a very simple but very important distinction, because many people forget this, and if you don't plan for this accordingly, you actually don't create as much wealth, you actually destroy wealth over the long term. Let me explain. The reason why most people love RSPs is the fact that they get a tax deduction for the amount that they contribute. But many people forget that they still have to pay taxes when they withdraw it, right? And what's happening here is that you're getting the tax savings today, you're getting the tax refund, but all you're really doing is just saying, you know what, instead of paying taxes today, I'll pay taxes 40 years from now. And the problem comes with what you do with that tax savings today. Because if you reinvest into your RSP, if you put into a TFSA, if you put into an investment, that's great. However, in reality, what most people do with their tax savings is that they use it for a vacation, they use it to buy a new car, they use it for their everyday expenses. And when they do that, they don't really take advantage of that tax savings. You might have been better off just actually paying the taxes upfront and putting that money into your TFSA, because you don't have to worry about paying taxes at the end when you withdraw the money. So the example I like to give is just imagine you're at a restaurant that you love and you have a meal there and you eat there pretty much every day. And because the owner knows you so well, what they say is that they'll put the meal on your tab. But you misinterpret that as a free meal. So every day that you come there, you order the fanciest things you can get. You get a 5-course meal, you get high tea, you get 3 desserts and 3 steaks, and you're enjoying yourself, right? And at the end of the month, you get a rude awakening because you realize that you have to pay this giant tab that you didn't account for. And this is the same with RSPs, because many people love the tax deduction up front, but they don't realize that over the years, as they're getting more and more and more of it, that there's this giant tab, which is taxes, that you have to pay when you actually withdraw your money, right? And so unless you make a proper plan on how to allocate your tax savings and how to withdraw the money efficiently, then you're not really taking full advantage of the RRSP, right? And the other thing that you want to note is that even if you're invested back into your RRSP or you reinvest into your TFSA, you still might have been better off putting it just into your TFSA. So again, like I mentioned in my last video, I will have a follow-up video explaining the pros and cons of TFSAs versus RRSPs when it makes sense for you and sharing more examples on that. So what else do you need to know about RRSPs? Unlike TFSAs, RRSPs have many nuances and many small details that you need to be aware of. And I'm just going to mention a few of them here. The first thing you want to note is that this isn't just for retirement. One misconception is that people assume that you have to keep your money in your RSP until retirement, when in reality you can take it out at any time. The only thing you want to note is that, like I mentioned before, you'll have to pay taxes on the amount you withdraw. So you want to just plan accordingly to minimize the amount of taxes if you do plan on taking it out before retirement. So the second thing you want to be aware of that's tied in with the first one is that the amount that you withdraw will be taxed as regular income. You can't take advantage of the taxation with capital gains or dividends when you're investing in your RSP. Third thing is that if you withdraw money out of your RSP, you lose that contribution room permanently. Meaning that if you take out $10,000, next year you can't recontribute that $10,000 unlike a TFSA. So you want to be extra careful when you're withdrawing money because you lose the tax advantages of that contribution room. The fourth thing you want to be aware of is that there are certain times you can take money out of your RSP without incurring any taxes. And the two most common times is one when you're buying your first home, and the second is if you're going back to school, right? So you don't have to pay taxes on the amount, but you actually have to recontribute into your RSP over a certain number of years, or else you'll have to pay taxes on it. The fifth thing is if you miss contributing into your RSP this year, but you do want to take advantage of the tax deduction, you actually have up to 60 days into next year to contribute into your RSP while still taking advantage of the tax deduction for this year. Meaning that if you contributed into your RSP of February 2020, you can still write off that tax deduction for 2019. Sixth thing is that there's something called a spousal RRSP where one spouse can claim the deductions for this year while the other spouse accumulates the assets and pay taxes on it at time of retirement. And this is a very common form of income splitting which you might want to take into consideration. The seventh thing is that even if you contribute into your RSP this year, you don't have to actually claim the deduction this year. You can defer it to later years if you know you'll be in a higher tax bracket later on. So the last thing I'm going to share is that you can't defer your taxes forever. The government wants their money. And so if you don't withdraw out of your RSP by the end of age 71, what's going to happen is that your RSP is going to convert into something called a RIP, where you're going to be forced to withdraw a certain amount every year. And in doing so, you pay a bit of taxes every year as well. Okay, so I know I threw a lot of information at you guys, and I'm really just scratching the surface in terms of how much detail there is with the RSPs. So I'll save that for future videos. So I want to end this video off by explaining a few times when it makes sense for you to invest in your RSP. The first and most common reason is if you're investing for the long term and if you're in a high tax bracket today. And what all that really means is that if your tax bracket today is higher than your expected tax bracket when you withdraw the money, then it'll make sense for you to contribute into your RSP. And so this is why most people think about retirement, because in retirement, you're probably not going to be working or not nearly as much. And so you're hoping that your tax bracket at that time will be lower than what it is today. Aside from saving for retirement, there's also other times where it might make sense. If somewhere in the future you know you're going to take a gap, meaning like a vocational leave, a parental leave, a maternity leave, or if you're going to take a couple of years to build up your business and you know you won't have much income at that time, it might make sense for you to invest into your RSP now to take advantage of the tax deduction and later on take advantage of your lower tax rate when you know you're not going to be making much income. One thing to note is if you're saving for these things like a vocational leave or a maternity leave, you want to understand that when you withdraw the money from the RSP, you lose that contribution room forever. And so you want to take this into consideration in your overall financial plan, not just to that one situation. The last time it might make sense is if you're saving up for your first home or if you're going to go back to school. Like I mentioned, there are certain times when you can contribute into your RSP, take the money out without paying taxes, as long as you pay it back over a certain amount of time. I wouldn't say this is a good primary reason to save into your RSP, but if you meet the criteria and the other two that I mentioned before, and you know you might be buying a first home or might be going back to school, then this might add another reason to put money into your RSP. And that's it. Again, I'm just really scratching the surface in terms of how much detail and how much nuance there is with the RRSP. And I hope you learned something in this video. If you did, leave a comment down below in terms of what you learned, or if you found something valuable and you want to learn it in more detail, I'd love to know, and I'll make a follow-up video on that. That's it for now. Thank you guys so much for watching this video, and don't forget to stay tuned for my next video on comparing TFSAs with RRSPs, seeing the pros and cons of both, and seeing which one will make more sense for you.